All right, this is a beginner basics call. I am recording this call and I'll upload this to YouTube. That way folks can follow up just to look at basics on how to use Tykr. This is a safe place. If you guys have any questions, don't feel bad if they're don't feel like they're going to be dumb questions. The objective here is just to increase your confidence with investing. I did a little bit of not recording, but I showed Tykr here right before, so I'll just kind of repeat myself. About 80% of the customers that come to Tykr are complete beginners. So if that's you, you're in the right place. About 20% are people who have a bit more experience, but they use Tykr to save themselves a lot of time. All right, we're going to go ahead and kick this off. If you guys have any questions, please go ahead, drop them in the chat. Otherwise, I'm going to start adding you guys to the call. And I do see we do have two places you can type. You can go to the chat window, or there's a Q&A tab. I'm looking here. I see to get the daily email that includes upcoming earnings off your watch list, is it supposed to be from my watch list? Because none of the stocks listed are mine. Right. So there's multiple categories. There's upcoming earnings on your watch list and upcoming earnings off your watch list. So off means there's stocks not on your watch list. It's kind of like saying, and a few customers come to me and say, hey, Sean, can you create a feature that gives us a heads up on stocks we're not following? Like, how do we get notified of like hidden gems and stocks that are making moves that we're not aware of? That's what the off means. On is stocks that are like, for example, on my watch list, I've got Amazon, I've got Microsoft, I got Google, the usual suspects. But I like it when I get notified by Tykr of stocks I'm not studying, I'm not even aware of, but I'll see it come through and that'll be off my watch list. And I'm like, oh, okay, I've never heard of this company. And it just went from overpriced to on sale. That tells me the financials are really improving. This might be a hidden gem before it gets to CNBC News or some media outlet. That's, yeah, yep, I see you said thanks here, Rudy. You got it. Um, there are a lot of big news outlets. They're going to get information, but it's going to be really delayed on a popular stock, whereas Tykr can really cut through the clutter, get the financials early. And when you see a stock that goes from like, I'll show you my screen here, give you an example. Let's say we're on Nvidia here, so this is a really good example. Let's say you see a stock that goes from an EPS here. This is the number one most important line on the financial statements. It's earnings per share, which is pretty much, it's very similar to net income. It's just net income divided by outstanding shares. But if you go from like a 8 cents, like you see here, up to this 25 cents, and the stock flips from overpriced on sale, I want to know about it. And that might be like, ooh, what do we got here? This might be something like a diamond in the rough. So that's what off. Yeah, I know you guys got it, but off your watch list means. Just a heads up here with a daily email. I'm going to add you guys to the call here in a second, but I just want to give you context on what we're working on. The next big feature, we're going to be showing projections, comparing the Tykr fair value against Ben Graham, who was Warren Buffett's teacher. Then there's Phil Town, and then discounted cash flow. So 4 different fair values on one screen, so you can see where stocks are going in the next 1 year, 5 year, 10 years. Also, proven results shows how it's like proof in the pudding. How does Tykr actually compare to the S&P 500? So that's coming soon. We'll also be working on the community feature so you can follow other people. You get notified when they buy and sell stocks. You can kind of see their portfolios. Everything will be in percentages. You won't see dollars. So if you have a portfolio that's $100 or $1,000, don't worry about it. Nobody's going to see the dollars. We want to keep it an even playing field across the board. So we only see percentages, like what percentage of your portfolio is in, for example, in my case, Apple or Google, so on and so forth. And then you'll see the returns. So that's what's coming soon. But with the daily email, one thing we want to work on is the ability for you guys to customize it. So you can customize and show what modules you want to see. For example, I should show you guys here. Give me a second. I'll bring over my daily email from today. Yeah, here we go. Perfect. Just bear with me 1 second. Here we go. Got it. So you can see these modules popping up like upcoming earnings off your watch list, and then top gainers like here are stocks off your watch list. And what I could maybe do is, so there's no confusion, this is to you, Rudy, and other customers, because somebody else did ask the same question, so you're not alone. Um, I could say here are stocks not on your watch list. So that's it kind of defines what off means. But anyway, you'll have the ability to turn on and off these. So if you don't want to see like earnings, there you go. You can toggle these on and off and then customize it so you only see stocks related to your country. Because some people did ask about that. For example, we've got customers all over the world. There are a few customers from India that were like, "Hey, we only want to see in our daily summary stocks from India." No problem. A little bit of a project, but that will give you guys more flexibility with this daily summary. All right, let me stop sharing, and then I'm going to start adding you guys to the call. I want to make sure I get the chat window up here. Um, Real quick here, there's a question from Anis Ahmed. Hopefully, I didn't slaughter your name there, but you asked, how is the stock split impacting the Tykr score? The answer, stock splits don't impact the score. What does, and I'll share my screen, we'll take a look at Tykr. This over. We'll actually go to NVIDIA again. A stock split doesn't impact the summary score margin of safety. What does? And if you guys are interested, you can go to Tykr.com. This is all free information, education. You can go to education, then calculations. You can see how the calculations are achieved, such as the fair value, margin of safety, the summary, the score. All that's within, you can see. So what drives the summary score, margin of safety are the financial statements. So it doesn't matter if you have a stock split or not, it's all related to financials. And here's a way to eyeball it. If the revenues are increasing year over year and quarter over quarter, there's points given there. Same thing with income, EPS, free cash, assets, and equity. So 6 of the 8 lines you want to see increasing, and then the 2 lines you want to see decreasing or kind of going flat would be liabilities and debts. In this case, liabilities are increasing a little, but not nearly as much. If you toggle from liabilities over to revenue, you see the revenues are a lot steeper incline. When you see revenues and liabilities increasing at the same rate, that's not a good sign. That's very similar to like a service business, like a small service business. If you are increasing your revenue, serving more customers, typically you have to hire more employees. So your profit margins stay the same, not ideal. Yet your revenues and liabilities go up. I only know from experience because I had a service business and agency in the 2000s. Kept growing, adding more people, but the profits in my personal bank account, no difference. Big lesson learned. All right, so that's how you get to the summary score in MLS. Can't believe NVIDIA is showing a score of 92. Yeah, I agree. Getting above 80, so you guys know with the the 4M confidence booster, if you guys never use this, it kind of gamifies the experience. I'm not going to go through it now, but it breaks things down with the 4Ms. You got the math part with it, which we call the margin of safety. And this is all inspired by Phil Town. I'll show you online who he is. He's been investing for a long time. He's a really good guy. And I give him a lot of credit for Tykr. Same thing with Warren Buffett and Charlie Munger, but he really coined the phrase 4M. And he uses kind of a different order. I like to start with the math part first. So going to Tykr, and then you get the meaning, which is the business model and how scalable are the revenue streams. And you've got moat, how does it compare to other companies in the same sector and industry? And then you've got management, which is track record of the CEO. Now, doing these manually, this could take you days of research. Well, we reduce that to seconds with the 4M tool. And like Anis was mentioning, getting to 92 is really, really tough. You can see some of the scores people are getting here. We use the average over here, the 92, but I see a 99 from Kimberly. Yeah, 95 down here. Really, really impressive. And why the scores vary is because every time you do it, it picks a few other companies to compare against in the moat section. So that's where you get that variance. So yeah, this is like, if you're not sure, like on sale, score, and MOS are like, financials look really good, but what's the 4M? This kind of rounds out everything to make sure those 4Ms are good. So if you can get a high 4M score, that gives you a lot of confidence. Good. Anis, glad I pronounced your name correctly. Sometimes I'll screw that up. All right, I'm going to start adding you guys to the call. You can ask questions. Give me a second. I'll stop sharing here. Hold on. All right, Denise, I've got you added. Anthony, Carmen, welcome. Devin, got Gerard. I think I was emailing you this morning, Gerard. I can't recall. Then I've got Melissa, Muhammad, Pear, Ralph, Rudy, Santiago, and Sina. Guys, welcome to the call. So if you have any questions, go ahead, speak up. If anybody asks a question at the same time, I'll just kind of call out which is first. So I see two people unmuted, Anis and Anthony. Any questions you guys have right away?
Not presently, but enjoying the webinar thus far.
Awesome. Thanks, Anthony. Appreciate it.
Hey, it's Devin here. How's the Corning stock doing?
Let's check it out. How are you doing, Devin?
Doing well, man. Last I checked, it was one of the only gainers on the market a few days yesterday.
Corning. I'm looking here. Was that Owens Corning?
No, the other one.
Top one?
I believe so. Sorry, I'm driving, so
I
got a little
gotcha.
screen.
I see Corning Incorporated, GLW.
That's the one.
That's the one. Okay. Yes. Oh gosh. Were we emailing about this earlier in the week?
No, we talked about it the last conference.
Got it. Okay. Yeah. That's right.
You
Corning.
defied the logic. Yeah.
I see that. So yeah, you guys looking at my screen here, please, if you're driving like Devin, keep your eyes on the road. This one here, one of those stocks that if we look at the 1 month, it's really taken off like a rocket. But look here, it's overpriced. It's got a 28 out of 100, which is like, we're talking like GameStop territory. In fact, I poke fun at GameStop all the time. We'll go to GME. Yeah, that's a 28 as well. And then you can see here the margin of safety, 1%. And then in the middle, that 4M is a 39. So again, if you get 59 or lower, that's like a sell. Let's see what GameStop is at. GameStop's got it beat at 48. Look at that. So I'd be very careful now with this one here. It's kind of taken off like the rocket, and typically that's emotions. Emotions are driving this at the moment. But let's go to the earnings calendar. If you look at this, like we've got an earnings report on Corning on 7/29. If they miss, like large financial institutions move share prices up and down. If they were to, like you can see here, the last estimate was 35 cents and it came in at 38. But if the next estimate is like, let's say 35 cents and it comes in at like 25 cents, that's a big miss. And that's when this share price will go back to 1 month. It could just fall off a cliff. So that's why it's got to be so careful with those overpriced stocks, because yes, they can take off, but again, those quarterly reports can send it abruptly the other direction. So just be careful. I was taking real quick here, Devin. I was just taking a quick peek at the model, their business incorporating display technologies, optical communications. I like to go to the details tab here and just kind of skim.
Yeah,
I
they
know
were the fiber optic for AI. Remember?
that's right. Yeah,
That's right.
here's their site. So yeah, sometimes if you guys are curious, like, why is this overpriced stock taken off? I'll go to the news tab and see if there's any news here that's driving this. Sometimes, like today, or like these days, if you see something related around they adopted a new AI tech or they're creating AI tech, it's buzzwords like that can drive the share price north. And people are like, oh yeah, let's pile in. It's just calm down. We saw this repeats like in the early 2000s. I don't know if some of you remember that, but everybody was adding like .com to their business name. This is the .com bubble, and some of these businesses had horrible, I shouldn't say some, most of these businesses had horrible financials, but just because they added .com to their name and saying, hey, we have a company website. I know we laugh at that these days, 20 years plus later. But literally, businesses would say they're .com and they got a website, and their share price would take off. And like again, horrible financials. So just be careful. The buzzwords are flying around. Interesting. I see a lot of headlines here. Why it was S&P top performing stock. Interesting. Let's go to Seeking Alpha. Seeking Alpha is a subscription site competitive to Tykr. I like to just be transparent with our customers, and I'll never talk down about our competitors. The two best would be Seeking Alpha and Simply. I'll show you my screen here. Simply Wall Street. They're based out of Australia. I would say Tykr is a bit easier to use just based on customer feedback, but the thing that Seeking Alpha does really well is they have a whole bunch of people writing articles on the platforms. You can see articles like this that it's just kind of fun to read, but it doesn't help me buy or sell a stock. But if you want more stock information, Seeking Alpha is a great choice. So anyway, I get a paywall here popping up, so we're gonna skip past that.
Hey, Sean, I do have a question. This is Anthony.
Sure. Hey, Anthony.
Two things. How are you feeling about the long-term future of the marijuana stocks with all of the medical marijuana stuff? We have some stocks in that. Initially, when we purchased those several years ago, they appeared to be doing well, but then there's been a drop off. So how are you feeling about those? And we'll just start with that. How are you feeling about those stocks or the future of the marijuana stocks?
Yeah, good question. So to give you context there, a few years back, you probably remember when Canada went legal. What was that? 2019 or 20? Here, when
Yes.
did I'm just doing a quick Google search. When did I'll answer your question here
Sure.
shortly.
Take your time.
When Canada go legal with marijuana? Yeah, October 17th, 2018. Okay, so prior to that, I was like, interesting. Let's see what happens here. And I think I put $1,000 into it wasn't Canopy as somebody else, but and this was probably 16 or 17. And when that legalization happened, I saw the tell, which was nothing happened to these stocks. And I had a feeling about that because I always try to like when you guys invest in businesses, I try to put myself through the customer's point of view or like the behavior of human beings with certain businesses. And I was thinking through like, okay, so I live in Wisconsin. If you guys don't know that, we get the Green Bay Packers, we've got the Milwaukee Brewers, we get the Milwaukee Bucks. When people go to these games, I was like visioning in my head, are people going to stand in lines for beer, like a cold beer on a hot summer day at the Milwaukee Stadium, which is the American Family Stadium? Are they going to do that, or are they going to stand in line for pot brownies? And I'm like, there's no way they're standing in line for pot brownies. There's no way. And then I was thinking about weddings and banquets and events. It's typically an alcoholic beverage. They're going to gravitate towards, not marijuana. So I, walking through that situation and at the same time thinking about the Canada legalization and stocks increasing zero, I knew at that point it's time to sell. Like a few friends that are like, no, Sean, like marijuana is going to be a huge industry. I'm like, I don't see it. The financials of these businesses aren't the best. It's not a hard business to start. That's another factor too. For example, I have a buddy of mine, his father has a dehumidifier manufacturing company. Not the most glamorous business model, but definitely needed for a lot of different businesses they have foods and um, plants and whatnot. Well, guess what? They started getting a lot of calls from people starting like marijuana. I don't know if you call it not manufacturing, but harvesting, where it's simply create a greenhouse, order dehumidifier, you create an LLC, legal business account in the States, and you're off and running. I'm like, there's no moat here. As Warren Buffett states, you really want a wide moat. Well, there's no moat. It's easy business. So it's like you could have 100 other competitors in the same city. It's like, oh, I don't like that either. So all the boxes were not being checked. So my friends that held on to it, and we're talking friends that bought were like $10,000, $20,000, $30,000 worth of marijuana stocks, they all lost money and it's not taking off. And I'll go to Canopy. I'll show you guys something here. This is a really big lesson learned from my friends. We got Canopy Growth Corporation, NASDAQ. All right, let's go there. All right, you can see this is the story of the stock was that February of 21, it peaked and then it really trailed off. Now this stock here, this is something to pay attention to. They never got to 521. What they did was a stock split, but it's called a reverse stock split. Whenever you have a stock split and it moves from I'll stop sharing here and then I'll give you really what I feel about where this industry is going. Whenever you have a stock split and it's like Nvidia's 10 for 1, you want a bigger number moving to a smaller number. That's a good sign because what it does is it lowers the share price. So the barrier to entry is lower and more people can pile in. But when you reverse that equation, you go from a smaller number to larger, like Canopy did a 1 for 10, not a 10 for 1. What that does is they're trying to inflate the share price so it looks like a more attractive stock. They want to bump it up above penny stock territory, which is anything that's $5 or less US dollars. Well, that's what Canopy did to try to get more interest. Nothing happened. So, in my opinion, strong opinion, marijuana stocks, they're not going to be big in the future. It's just, I think some people are going to, use it, medical marijuana. I think it has its place, but it's not an investable or bankable business model I would ever invest in.
Thank you, Sean.
Yeah. Yeah. Sorry. Long answer there, but now you guys know how I feel. My friends are really upset they didn't listen to me about that industry. All right. Rudy, I see here you mentioned you are retired. Is Tykr useful some with a 5-year perspective? In that case, yep. To answer your question there, Rudy, with Tykr, and there's an article in our onboarding that we've got a bunch of emails that go out. We talk about the difference between wealth building mode and wealth protection mode. You would fall into wealth protection mode. To give you guys context, if you're in wealth building mode, you're still working. You have a timeline to achieve financial independence or retirement, could be 5, 10, 15 years out. In that case, you want to be in about 10 to 15 stocks. Now, if you're in wealth protection mode, that's when you want to move from those individual stocks to more ETFs. ETFs and index funds are great. A mutual fund is similar, but it's going to have a higher expense ratio. What that means is, for example, like an ETF or index fund is you're going to get charged per year to hold it, but it's really small. It's like 10 cents or 20 cents, or not cents, percentage, like 0.1%, 0.2%, really small. Whereas holding a mutual fund, it's the same product, a bundle of stocks, sometimes stocks and bonds, could be 100, could be 1,000 different stocks and bonds in one together. But essentially, you're getting charged an expense ratio where a mutual fund can be as much as 1%, not 0.1%, but 1% on up to 2%. So it can be quite expensive. So I say gravitate towards index funds and ETFs. And then another option to consider is keep your money in dividend paying stocks. Examples in my portfolio are Microsoft and Apple. Just for holding the stock, you get paid a quarterly dividend just for holding the stock. And that way you don't have to sell shares to, enjoy hobbies in life or do what you want to do. So I like a mix when you're in wealth building mode, kind of a mix between dividend stocks and ETFs and index funds. So what you could do, Rudy, is look at, I'll actually show you my screen here. We'll go to ETFs here on the left. And then we just added a really helpful feature where you guys can see the 1 year, 5 year, and 10 year returns. Knowing that 5 year perspective, you could do this. You go to personalize, and we've got 1 year, 5 year, 10 year. Let's go ahead and let's arrange these a little differently. We've got score, share price, summary. I like to go summary score. I'm going to drag this down. 5 year, 1 year, 5 year, 10 year. We'll hit apply and let's see what we've got. A nice benchmark for you guys to remember or just kind of keep in the back of your mind is I like to look at 5 year returns, and the S&P 500 typically returns about 80%. So if you can find stocks that are at 80 or higher, that's saying that, hey, it's matching or beating the market. So an example here is this iShares semiconductor ETF is, look at that. It's just crushing the market. So you could look at maybe 2 or 3 different ETFs. This is a high flying ETF. You don't typically see ETFs with that big a return, so that's quite impressive. But then again, semiconductors are super hot. We'll keep going down here. You get the idea. You can see some of these. I see a 78, which matches the market. That's an India one. Microsectors, FANG plus index, that to me, it probably is ETFs. We'll click on one in just a second. I'll keep going here. Actually, we'll go to...
Sean, I also have a question on the screen.
1 second. I'll show you guys here, and then we'll jump back. If you guys are curious, you can click on these. You can see those returns. Like here, you can see 86%, and then you can see what's in it. And I like to go to the weight. So you can see here Microsoft has the biggest weight at almost 7%. And you can kind of toggle between. So that gives you an idea what's constructed of ETF. So hopefully that gives you a little guidance, or at least an idea what you can do there, Rudy. All right. Yes, was that Anis? Were you speaking up?
Yeah,
Sure.
great, Sean. Generally I was referring to the score and the what do you call that?
Summary?
No, the just a second. Let me refer to my screen. The MOS, margin of safety. So
Yep.
I normally refer the score and the MOS to decide on a stock. But you just showed now the 5 year returns will also be a good indicator to zero in on the stocks. So I wanted to ask you, my original question was, what is the tipping point? If I just look at the score and the MOS, whether anything above 50 on both will be the tipping point, or 60 or 70, how exactly do you approach? The 5 year return is a very good yardstick for sure.
Yeah, so that's, I'll give a little context here in ETFs, and then we'll jump over to the stocks page. With ETFs, so you know, what we do is, and this is a quick fix we're making in Tykr, like this one should be watch, because the biggest percentage you can see here is watch. So these got to correlate. Somebody else pointed this out on a call, and we're working on that bug fix. But at the end of the day, ETFs don't split hairs on them. The idea is pick 1, 2, or 3. And again, their job is not to build your wealth, it's to protect it. And if you go to a financial advisor or wealth manager, in most cases, they're going to do the same thing. They're going to pick a few ETFs, put you there, move on to the next customer and do the same thing, because their job is not to build your wealth, it's to protect it. And I've had a lot of people on my podcast, a lot of financial advisors on my podcast say the same thing, because buying individual stocks for 100 different customers, it would take you all day. You'd be working 24/7. So that's why I just pick a few, keep it there, protect it. Now, to answer your question, Anis, we'll go to the stocks page. Actually, I'll show you guys my watch list so you can see what's on it. Let's go to, we'll scroll down here. In order to get to on sale, like here's one, Appfolio. We'll go to Bluebird. We'll go to Bluebird here. They make school buses. Just for context here, I was surprised by this, but you need a score of 50 or higher. So that's a tipping point there. And then you need a 50% or higher on the margin of safety. You can get to both those, then you get to on sale. That's the criteria.
Okay, clear. Thank you. So
Yeah.
the 5-year returns or 1 year or 10 year is just going to give you more filters, right?
Sorry, it came in a little softer on your audio, but you mentioned returns. I'll look at, actually, let's play with the filters here. We'll go to on sale, and then I'll go to 5-year returns, and we'll play with that. This number here says 45,000. Let's just see, because this changes every day because stocks are going public and going back to private every day. So it's always shuffling. So this number here, you could see might change from day to day. So I just want to see how many today are on sale. We'll hit apply. All right, 6,000. Yeah, that might be about that, going 6,000. That range, yeah, 15 to 20%, somewhere in there. All right, then let's go to 5-year returns. Let's go, we're going to go 80% to 500%. And let's see how this narrows down. All right, brought us from 6,000 to 2,000. And let's play with that percentage a little bit. Let's say you want to beat the market by a little. So 100% to 500%. So we get okay, but from 2,000 down to 1,700. So there you go. That gives you guys an idea of a filter you could kind of play with. These are strong stocks, financially strong stocks that happen to beat the market. And then if you guys don't know, you can save this. You could call it like market beaters, say. Save it, and then it'll save there, and then you can go back and reload it so you don't have to play with the filter again. So that's an idea for you. So does that help answer your question, Anis?
Yeah, very much. Thank you so much.
Sure. Yeah, you bet. Stop sharing here. What other questions you guys have? And again, if you guys are you're in a call, if you're working or something, you can use that chat or Q&A. Some people will do that. Multitasking on the job. We do have time as well. I do have those live stock reviews. Tykr has come such a long way since the early days when I joined. Great work in progress. Yeah, thank you, Sina. I'm curious, when did you join? Do you remember the month and year? We just we crossed our 4-year mark here, July 1st. We went live on July 1st, 2020. I was in the first LTD. Nice. Okay, so you got a good deal. Good for you. Yeah, thanks for staying with us. Okay, Anis, you got a question here on crypto. So yes, I'll go to Tykr here, looking at my screen. We can analyze stocks, of course, because they have the financial statements. We'll go to, this is one of my favorite stocks, which is Microsoft. You can analyze businesses or stocks because they have the income statements, income, cash flow, balance sheet. And we can analyze ETFs because they're just really a container of stocks. So what we do there to analyze, for example, stocks, we'll analyze all the stocks in the ETF. Like if we scroll down, you can see what's in it. You can see like Broadcom, NVIDIA, AMD, and then roll up the score and summary from there. So that's how you do stocks and ETFs. Whereas crypto's not a business. So here's Bitcoin. It's not a business. It doesn't have an income statement, cash flow statement, and balance sheet. So that's why there are no ratings on coins. The question is, why do we have crypto in Tykr? The reason is we do get a lot of people that want to quote unquote trade crypto, and we bring them in and we lure them, or not, I shouldn't say lure, that's probably not the right word, but we do guide them to say, hey, you can invest in crypto. Like I think Morgan Stanley has said, try to go like 5% or less of your net worth. We say the same thing. Be super careful. Keep in mind, any crypto coin can take off like a rocket one day, but it can fall off a cliff the next day. So that's why be very careful. So that's why we bring people in, we educate people on the risks. And you can see here, we've got little disclaimers here and then an investing tip. Due to the volatility, we recommend you invest 5% of your net worth or less and large cap crypto coins. So that's why we can't analyze where Bitcoin is. Like there's no summary score in MLS because it's a digital coin, not a business. All right, there's a question here from Carmen. I realize it's probably a simple question, but what variables would you use to decide to sell or hold a stock? Yes, really good question. So here's the criteria to buy a stock. I'll do buy and sell for you so you can see both sides of the equation. So a good buy, you're looking at two criteria. Number one is the stock on sale. And number two is that 4M score is close to 80 or higher. You can see my columns, how I organize them. If you guys are curious here, I'll go back. You use this personalized tab. You can arrange in whatever order you want. So I like to see the summary, score, MOS, and 4M right in a row. That's my preference, at least. Then I'd like to see the 5-year just to get an idea like, hey, does it beat the 80% to the S&P 500? So you can see here, okay, so Aon, it's got to watch, although the 4M is high, so that doesn't quite meet my criteria to buy. Let's keep going down. I see Duolingo's on sale, but it's got a 72, so not quite there. All right, we got Comfort Systems. Here we go. This is one of the stocks top of my watch list. Okay, 100 out of 100. They are focused, think of comfort. It's heating, air conditioning, ventilation, mostly for corporations. So definitely a necessity. I can't imagine anybody, working in a building that's, here in Wisconsin during the winter. If you don't have heat, you got a problem. Definitely a necessity there. So this one meets the criteria to buy. Now to sell, let's go back to the watch list. 3 criteria. When it flips from on sale to watch or overpriced, and you're going to see those changes in your daily summary. That's why you definitely don't want to unsubscribe from that. Keep that daily summary so it flips from from on sale to watch or overpriced. That's number 1. Number 2, that 4M score drops below 59. Let's go here. We've got like I recently sold AMD. Look at this, 59 on that 4M. It's overpriced. This tells me the whole business, everything's looking pretty weak. It's going the other direction. And the third criteria, Carmen, this is really key to pay attention to. And this is, I give credit to Phil Town and Warren Buffett on this, but it's called Rule 1 investing. In fact, his brand is called Rule 1, which is don't lose money. Rule 2, don't forget Rule 1. And I'm going to stop sharing here so you can see me. So again, just to hit those 3 again, you've got it flips some on sale to watch overpriced. Number 2, 4M score 59 or lower. And number 3 is that you only sell for profit. You don't lose money. So in my case, if I have a stock that flips from on sale to watch or overpriced, and that 4M scores a 59 or lower, but I'm in the negative, I will have the discipline to hold it because the market's going to push stocks up and down like waves in the ocean. Motley Fool, if you guys ever listen to the guys over there, on that podcast, they use the phrase "a rising tide lifts all ships," which essentially means the market's going to go through these rallies and it's going to lift a lot of stocks up, even the ones with the weaker financials. So I will wait for those points in time to let the market lift up, and then I'll sell for a profit. I did that with, I'll show you my screen here again. I did that years ago with two stocks. Bought the stock went down, financials got worse. And this was when a Tykr was an Excel sheet. This was, gosh, probably 2016, 17, or 18. But one of them was Rollins. I'll show you their website so you know what they do. They sell like chemicals for pest control, like termites and ants and insects. You probably, if you guys ever recognize the name, Orkin is under the umbrella. Gosh, they own a lot of companies, but Orkin falls under. So I bought them, financials went down, and then the share price went below the cost basis, which is the average share price. If you ever hear cost basis, that's what that means. Average share, my average buy price, in other words. Well, the share price was below that. And I'm like, oh, shoot, what do I do? Do I sell for a loss? Well, it's like, nope, I'm going to follow rule one and I'm going to wait. So I think I waited like 6 months on that stock, and then it lifted high enough so I could sell for a profit. And then the other one is MODG, which is Top Golf Callaway. You can see their financials are awful. I'll go to their site so you can see them if you're not familiar. But same thing, it was the same story. You know, they got golf clubs, golf bags, golf balls. Anybody who's a golfer knows that brand. But yeah, I had to wait. I had to wait like 6 to 9 months, and then somewhere in that range, it did rise above. And even though the financials weren't great, it did lift high enough so I could sell for profit and move the money over. Now, in some cases, you may run into what's called an opportunity cost situation where you're like, gosh, I'm really close. I'm just in the negative, maybe a few $100 or maybe 1,000. You could say, hey, I'm going to sell for a loss, and that's going to offset my taxes for the year. Definitely talk to your tax professional, about this before doing this, but that way you take a loss. And then instead of waiting like I did 6 to 9 months, you can take the money that you do get back. It won't be your full amount, but you get some money back. And then you can invest in a stronger business and make up for the lost time. I don't do that a lot. I try to create discipline and train repetitive behavior of only selling for a profit. I know some people, and people that don't use Tykr, they're kind of investing blind. They'll buy a stock will go down, they sell for a loss. Next up, they buy a stock will go down, they'll sell for a loss. This is what most people do because they're letting their emotions take over and they're training a bad behavior at the same time. You don't want to do that. You want to remind yourself, okay, these are businesses. They're selling products and services that are solving problems for people. You got to be patient. You got to let it go back up. So I know I talked a lot there. Hopefully that helps you out. All right, and then you came back. So is crypto more technical than fundamental? Yeah, people that do buy and sell crypto, they'll use technical analysis, which what that means, if you guys don't know, they'll look at charts and really it's a volume play, what's being bought every day. It's extremely speculative. To give you context on trading, people out there, and I do have sources on this, especially in the onboarding, you probably saw it, but it's 99% of traders, not investors, traders lose money because they're trying to time the enter and exit, buy and sell. The same thing is with crypto. People trying to buy and sell, people who will put like crypto trader in their LinkedIn profile or their Instagram profile, they're not really trade. They're just speculative and they're riding the wave up, making some money. But when the market goes south, it's then they pull that profile label down. They call themselves something else. So yeah, be careful with technical analysis. It's a lot of people do lose money that way. And then, Anis, you had another question here. Sometimes I get confused and even tempted looking at the technical moves in stocks. I have not bought since it does not meet my MOS trend trading, and turtle traders claim they make more than value investing. With value, hopefully this will help answer your question, Anis, but in our onboarding, we do talk about the difference between investing and trading. And one of the key stories is there are 3,000 billionaires in the world. And of the 3,000 billionaires, and I'll say this to people in podcasts and people learning about the difference, will be like, okay, so of those 3,000 billionaires, how many are traders and how many are investors? Well, they'll think on that. I'll just wait for them to answer. And then they'll say, well, maybe it's a mix of both. I'm like, well, there are 0 billionaire traders, and of the billionaires out there, they're a mix between investors, so value investing, real estate investing, and entrepreneurs. So that right there just shows you, if you want to make money, you want to build your wealth, you really need to let the market do the work for you. It's not you, because trading is still a job. You're working. You're trying to look at charts and time in and out. It's like, there are people I've known that they'll make less than somebody, working minimum wage at McDonald's, because they'll go days without making any money, but working, 12-hour days trying to time the market. I don't know why, but some people love to do that. Okay. Anise, you got to laugh out of that if you realize that I have asked the question in some trader webinars and never got a reply. They would say traders like to earn and spend, It's like, just have the discipline to let the market work for you. That's the key. The value investing is all about working smarter, not harder. Sina said, got to run. Great seeing you. Yes, good seeing you as well. Thanks for jumping on. All right, anonymous entity of the stocks and trust ones you probably invested in, just recommendations. Yes, my portfolio, if you guys are interested, when you're in, you can click here. This goes to our Tykr.com. We've got a bunch of articles, but it shows this is my actual portfolio. Now, I don't keep this updated every week. If people are interested in that, I do have a service for the Premium Plus and Advanced plans where it's weekly trade ideas. If you guys are interested, it's kind of like going over my shoulder. And in this article, you can see an example, like what did I buy? NVIDIA. Why did I buy it? What did I sell? This is when I sold in AMD. Why did I sell AMD? Top stocks on my watch list. I listed Nova. Actually, I mentioned Comfort earlier. Intuit is there. I show you guys what percentage of my portfolio is in cash. It's always good to have some cash saved so you can buy, when the market goes down. That's what we want, as Phil Town teaches. It's, you make money when the market goes up, but you get rich when the market goes down. You want the market to go down because that's when you deploy that cash you have saved. And then you can see my updated allocation percentages within. So yeah, if you guys are interested in that, you can certainly upgrade. But yeah, those are actual stocks I hold. So Microsoft, Palantir, Fortinet is cybersecurity, Alphabet, of course, Google, you got Apple, PayPal. PayPal's been kind of a dud the last few years, but I still have strong conviction. NVIDIA, start buying more of them. Block is kind of a dud. PayPal and Block are fintech. Paylocity is HR, so human resources tech, and then Visa. I do like the credit card stocks. They're not big market beaters, but it's like a lot of people around the world use credit cards. So that's why I have that. I'll speak real briefly here on fintech or payment tech. So if you guys are newer to Tykr and you don't know, I have talked about in other videos, the most scalable business models on the planet. Scalable is you can increase your revenues a lot faster than your payroll liabilities. Well, the most scalable businesses would be ad tech. Think like Google, YouTube, which roll up under Alphabet. Then you've got Meta, you've got Amazon, which is advertising. When you empower your customers to put in their own credit card or debit card, or multiple credit cards and debit cards, to spend money in advertising, if they put in $1 to make $2, they're going to keep dialing that up. And I only know that because I worked for large companies for about 12 years. And I've been part of projects where they'll test advertising. And if they're making $1, they're not going to slow down. They just keep dialing that up. They've got the money to spend because they know they're making money in whatever ad spend they're making. So that's why you get companies that'll spend $100,000 in a month one, $200,000 a month two, $300,000 a month three. It's crazy how scalable it is for just one company. When you have thousands of companies doing the same thing, it's extremely scalable. Second to that is fintech, or payment tech, which is like a PayPal, Square, other companies that are private companies today. If you guys ever heard of Stripe or Plaid, very similar. They were thinking about going public the last 2 years, but they kept pushing it off because payment tech is just being beat down right now. Large institutions don't like it, which I don't get. I do see the tide coming back the other direction. So I think fintech could have a resurgence here. But how the model works is when you come between the buyer and seller and they're making transactions, little fees, they're not a lot of friction to the consumer, but when they're making hundreds of those over a month, times the number of customers, it could be 1 million customers, that's when the numbers get really big. And right now, again, payment tech isn't the most glamorous model, but I do see, again, a resurgence. So that's number 2. Number 3, I'd say would be enterprise SaaS, software as a service. You think of Netflix as consumer SaaS, whereas Salesforce would be like a enterprise. With enterprise SaaS, you get businesses spending, yearly. It's usually yearly hundreds of thousands of dollars, on it's $1 million per year for the software. Very sticky. And when you create expansion revenue, which means you'll have these big businesses buying more bells and whistles or features or adding more services, that customer revenue per year increases. It can get pretty big. Like Palantir is a good example of enterprise SaaS. So that's number 3. Number 4 would be SMB SaaS. That's small and mid-sized business. So think like Intuit. You have QuickBooks, and you have I think of MailChimp would be another good example. They own MailChimp as well. Active Campaign is email marketing. That's when customers aren't spending millions of dollars per year or even hundreds of thousands. They might spend like, $50, $100, $500 like that. But when you get a whole bunch of small businesses paying a monthly fee or a yearly fee, that's a scalable model. And then number 5, I did a video on this. I'm just doing a short version. Number 5 would say semiconductors. Anything around semis is big because chips are in everything from cars to phones to computers to microwaves, refrigerators. It's a necessity. So, I just gave you a rundown of the top 5 most scalable. Probably more information than you need to know, but just gives you a little insight to what I look for. All right, and then Anise, I see you're another question. Do you define stop loss levels to define and limit your losses, or you just live through the drawdowns, knowing its value investing in return? All right. Good question on stop losses. If you guys don't know what that is, in your broker, like I use Schwab, you can set a stop loss or a trailing stop loss. Here's an example. Let's say, the share price is at $100 and you set it so it would be like a trailing stop loss of $5. So let's say it goes from 100 up to 105, but then it starts going down, but my trailing stop loss is $5. When it goes from 105 back to 100, or let's say it's a $3 stop loss, so if it goes from 105 down to 102, it's going to sell automatically. And I found trailing stop losses to be very limiting. The reason is I did this with Lululemon and Meta years ago, where I had trailing stop losses on both. And I was actually using some technical indicators taught by Phil Town. And given I love him, he's great. His teachings have been very impactful, but he was using like moving averages and stochastic charts to really look at the numbers. And what I did was I was watching these numbers say, hey, let's sell, although Tykr was saying buy. This was when Tykr was Excel sheet. So it's conflicting. I'm like, okay, so the financials are still really good, but the technical indicators are saying, you should sell. And at the same time, the stocks, a lot of stocks in the market started pulling back. And I found this trailing stop losses sold Lululemon and sold Meta. And then what happened immediately after is both stocks took off like a rocket. Yet the technical indicators were saying still sell. And I'm like, okay, so financials are still good. Technical indicators say bad. Stocks are now taking off like a rocket. I keep watching them go. I'm watching them take off, and I'm missing out on big gains on both. And I ended up going back into Lulu, but Meta was already gone. It's like the rocket left the face of the earth, it was close to the moon, and I I couldn't even reach it. And I never went back in the meta, and I'm kicking myself for it. So I find that stop losses limit your returns. If you only want to make a little bit of money in the stock markets, like you maybe want to match the S&P 500, then use stop losses. But if you want to make big returns, do not use them, because you want the market to go down and you want to buy more. That's what that cash, excuse me, that's what that cash is available, so you can invest and watch it go, watch your stocks go like a rocket. But yeah, stop losses, I don't know why people are using, because you're putting training wheels on. You're really limiting. It's kind of like putting a governor on a car. It's you only can go a certain mile an hour. It just doesn't make sense. I know we're a little over here over time, but you guys are asking a lot of good questions. Can go another few minutes. Any last questions? I'm watching here in the chat window or the Q&A window. Yeah, you bet, Anis. I will get this uploaded to YouTube. So thank you for the feedback. Appreciate that. All right, I think we're good then. I'll go ahead and wrap this up. Definitely check out, I'll share my screen here. Check out the webinars page on Tykr. If you go up top, I've got a few coming up, such as there's one focused on families, like getting your kids to invest. Long story short, you can create what's called a custodial account. So any kids under 18, you can invest together. I think most places around the world have something similar. Might not be called custodial, depending on where you live, but it essentially allows you to monitor the trades you have with your kids, and then when they turn a certain age, they would inherit that account and they can use that on their own. So it's a great way to get kids involved. We got one here that's all around money mindset. One of my buddies, Bronson Hill, wrote a book. And then I got another livestock review in August. I think that's, yeah, August 22nd. So yeah, check out that page if you guys want to join any future webinars. But yeah, thanks for jumping on. Appreciate the good questions. And if you do have any follow-on questions, just go ahead and email support@tykr.com. All right. Well, talk to you guys later. We'll see you.